What on earth does a 500-year-old economic law have to do with a $2 billion crypto collapse? Well, welcome to the Druid Deep Dive. Today we're going to connect Tudor England to the wild world of DeFi to figure out what really separates a quality asset from a ticking time bomb. Let's dive in.
You know, this entire explainer, it really boils down to one central puzzle. It's an economic law you've probably heard of, but it's almost always misunderstood. And it all hinges on a single, critical condition that most people completely miss.
And at the very heart of this puzzle is the famous, or maybe infamous, Gresham's Law. So the basic idea is pretty simple, right? If you have two types of coins, and the government says, hey, these are worth the same, what are you going to do? You're going to spend the junky, debased one, and you're going to hoard the good, valuable one. This observation goes all the way back to Tudor England. But to really see it in action, and more importantly, to see where it breaks down, we need to jump forward to 19th century America.
So let's step into what I think is one of the most fascinating historical laboratories for money ever, the American free banking era. This was a time with no central bank, no single US dollar, just thousands and thousands of private currencies, all competing for your trust.
Yeah, you heard that right. Over 8,000. During this period, hundreds of privately owned banks issued all these different types of banknotes. I mean, can you imagine walking into a shop where the person in front of you pays with one kind of money and you pay with a completely different one? That was just daily life back then.
Okay, now this is where it gets really interesting. The market did not treat all this money as equal, not even close. As you can see here, notes from well-regulated New York banks, yeah, they traded at pretty much face value. But the notes from these sketchy wildcat banks out in Michigan, they were heavily discounted, sometimes worth less than half of what was printed on them. The market was actively and pretty efficiently pricing risk.
And this wasn't just guesswork, you know? A whole industry popped up to manage all this complexity. These publications called banknote reporters, think of them as the coin market cap of the 1850s, had over 100,000 subscribers. They helped merchants spot fakes and know the right discount for every single note. This just proves the market was perfectly capable of telling the good money from the bad.
So this brings us right back to our big puzzle. If the market could so clearly see which money was bad and just discount it, why didn't that bad money just disappear? If everyone knew which money was good, how could the bad stuff ever drive it out of circulation? What was the missing piece?
And here it is, the crucial point, articulated so brilliantly by the economist George Selgin. Gresham's law only kicks in when two different types of money are forced to trade at the same price, usually by some government decree or, say, a fixed peg. If you have to accept the bad money at the same value as the good money, of course you're going to spend the bad stuff first.
So this actually creates two completely opposite laws. When you have a fixed exchange rate, you get Gresham's law. But when prices can float freely, like they did in the free banking era, you get the total opposite, which Selgin calls Thier's law. Good money actually drives out the bad because nobody wants to accept the junk currency at face value.
Okay, now let's jump to the modern day. We're going to see how this exact same distinction led to a catastrophic $2 billion bank run in DeFi. This, my friends, is the story of Iron Finance.
So, Iron Finance created this stablecoin called Iron. Its whole goal was to be worth exactly $1 all the time. To do this, it was partially backed by a reliable stablecoin, USDC, but also by its own super volatile token called Titan. And here's the kicker. It enforced a hard, fixed one-to-one peg. You see where this is going, right? They created the perfect petri dish for Gresham's law to take over.
The growth was it was insane. I mean, fueled by yields promising over 1,700% returns, the protocol ballooned from $30 million to over $2 billion in just 3 weeks. But then on June 16th, the big money, the whales, they started selling. And within hours, the Titan token just completely collapsed, going from $65 to basically zero, which triggered a full-blown bank run on the Iron stablecoin.
So the big question is, who saw this coming? Who started the panic? Well, thanks to the beautiful transparency of the blockchain, a Federal Reserve research paper was actually able to analyze every single transaction to see exactly who ran for the exits first.
The on-chain data it's crystal clear. The largest, most sophisticated whale wallets, they fled. They reduced their holdings by nearly 100%. And who was on the other side of that trade? Smaller retail accounts who were trying to buy the dip and were, unfortunately, left holding a completely worthless bag.
So the protocol's design had this absolutely fatal flaw. When you wanted to redeem your Iron, the system used a 10-minute delayed price feed for Titan.
So as Titan was crashing in real time, savvy users could redeem their iron at an artificially high old price, get a flood of now worthless Titan, and then immediately dump it on the market, which just accelerated the collapse. This was the modern high-speed version of the note shavers from the 1800s.
So, what can we actually learn from all this? What are the crucial, actionable takeaways from this deep dive for anyone trying to navigate the DeFi space today?
Okay, first and foremost, always recognize when a fixed-rate peg is creating the perfect conditions for Gresham's law. Second, you have to remember that big, sophisticated money always moves first. Watch what they do, not what they say. Third, a 1,700% yield doesn't mean a thing if the collateral backing it is just smoke and mirrors. And finally, you've got to learn to tell the difference between a single bad project blowing up and a problem with the entire system.
Look, the core lesson is this. Insane yields that are funded by just printing more and more tokens are a house of cards. They need constant new money just to survive. The real takeaway from both 19th century banking and 21st century DeFi is that competition only rewards quality when the market is free to actually price the risk. An artificial peg just hides that risk until it's way too late.
And as we wrap up, just a quick reminder that this has been the Druid Deep Dive. This explainer is purely for educational purposes to provide some historical context for DeFi. It is definitely not financial advice.
So I want to leave you with this one question. The next time there's a major crisis or a big DPEG event, think about the assets you hold. Are they in a system with a fixed rate, governed by Gresham's law, where bad money is designed to win? Or are they in a free-floating system, governed by Thier's law, where quality will ultimately prevail? Knowing the answer could make all the difference.